Let me tell you about one of the greatest investments I have ever made, and it happened in a business that most sophisticated investors completely overlook. It was 2012, and I was sitting across the table from a management team that had just taken over a struggling restaurant chain. The stock was down over 90% from its highs. Wall Street had given up on it. The narrative was that the brand was dead, that consumers had moved on, that there was no coming back. And I saw something completely different. I saw a business with real estate worth more than the entire market cap of the company. I saw a brand that still had emotional resonance with millions of Americans. I saw a new management team with a clear plan to cut costs, simplify the menu, and reconnect with customers. So I made one of the largest investments in my fund's history, and over the next several years, that investment returned over 400%. It was one of the defining trades of my career. That experience taught me something profound about restaurant investing. This is a sector where fortunes are made and lost, where the difference between a great investment and a disaster often comes down to understanding a few key variables that most investors miss. And right now, at these prices, I am seeing opportunities in the restaurant sector that remind me of that 2012 moment. Not because everything is collapsing, but because the market is mispricing some truly exceptional businesses. To date, I am going to share the only 3 restaurant stocks I would buy at current prices, but more importantly, I am going to teach you the framework I use to evaluate restaurant investments, the specific characteristics that separate winners from losers in this brutally competitive industry, and the mistakes that cause most investors to lose money in this sector. If you understand what I am about to share, you will never look at restaurant stocks the same way again. Before I reveal the 3 stocks, let me take you back to a moment that shaped how I think about the restaurant business. It was 1997, and I was doing research on a fast food company that everyone thought was a screaming buy. The stock had dropped 40%. The dividend yield was attractive. The brand was iconic. Every analyst on Wall Street was saying this was a no-brainer. I spent 3 months studying this business. I visited over 50 locations in different cities. I talked to franchisees, to suppliers, to former executives. I analyzed the unit economics down to the penny, and what I found terrified me. The company was opening new restaurants at a furious pace, but the average unit volumes were declining. They were cannibalizing their own sales. The franchisees were struggling. The food quality had declined as they cut costs. The brand was slowly dying, one disappointed customer at a time. I did not invest, and over the next 5 years, that stock dropped another 60%. The company eventually had to close thousands of locations and completely reinvent itself. The investors who bought on that 40% dip lost most of their money. That experience taught me that restaurant investing is unlike any other sector. You cannot just look at the financials. You cannot just look at the brand recognition. You have to understand the unit economics, the competitive dynamics, the consumer trends, and most importantly, the quality of the experience being delivered every single day in thousands of locations. Get any of these wrong, and you will lose money no matter how cheap the stock looks. So let me share the framework I use to evaluate restaurant investments. I call it the 5 pillars of restaurant value, and every successful restaurant investment I have made has scored highly on all 5 pillars. The first pillar is unit economics, and this is by far the most important. A restaurant is essentially a small business that gets replicated hundreds or thousands of times. The economics of each individual unit determine everything about the company's future. You need to understand the average unit volume, which is how much revenue each restaurant generates. You need to understand the 4-wall margins, which is the profit each restaurant generates before corporate overhead. You need to understand the build-out costs, which is how much it costs to open a new location. And you need to understand the payback period, which is how long it takes for a new restaurant to return its initial investment. The best restaurant companies have unit economics so strong that franchisees are desperate to open more locations. They have average unit volumes that are growing, not shrinking. They have 4-wall margins of 20% or higher, and they have payback periods of 2 to 3 years, which means franchisees get their money back quickly and then enjoy years of profits. The worst restaurant companies have the opposite. Unit volumes are declining, Margins are being squeezed by rising labor and food costs. Franchisees are struggling and not reinvesting in their locations. This creates a death spiral where the customer experience deteriorates, which drives away more customers, which further hurts unit economics. I have seen this death spiral play out dozens of times in my career, and it almost always ends the same way, with the stock going to zero or close to it. The second pillar is brand strength and positioning. In the restaurant industry, your brand is your moat. A strong brand allows you to charge premium prices. It creates customer loyalty that survives temporary setbacks. It attracts the best franchisees and the best real estate locations. A weak brand means you are competing purely on price, which is a race to the bottom that nobody wins. But brand strength is not just about recognition. Plenty of restaurant brands are well known but still fail. What matters is whether the brand stands for something specific and valuable in the consumer's mind. Does it own a category? Does it have a clear identity? Can customers articulate why they choose this restaurant over the dozens of alternatives? The strongest restaurant brands have what I call category ownership. When you think of a certain type of food or dining occasion, they are the first name that comes to mind. That mental real estate is incredibly valuable and incredibly difficult to dislodge once established. I have seen brands lose this mental real estate through years of neglect and poor execution, and I have never seen one successfully reclaim it once lost. The third pillar is management quality and capital allocation. Restaurant companies generate a lot of cash flow, and how management deploys that cash determines whether shareholders get rich or get destroyed. Great restaurant management teams return cash to shareholders through dividends and buybacks when the stock is undervalued. They invest in technology and operations to improve the customer experience. They are disciplined about new unit growth, opening restaurants only in locations where the unit economics will be strong. Poor management teams do the opposite. They pursue growth for growth's sake, opening restaurants in bad locations that dilute the overall economics. They make expensive acquisitions that destroy value. They pay themselves lavishly while shareholders suffer in the restaurant industry. Management quality matters enormously because the business requires constant attention and adaptation. Consumer tastes change, competitors emerge, costs fluctuate. You need a management team that can navigate all of this while staying true to what makes the brand special. I have learned to pay close attention to how management teams talk about their business. The best ones speak in terms of customer satisfaction, franchisee profitability, and long-term value creation. The worst ones speak in terms of growth targets, market share, and beating Wall Street estimates. These different mindsets lead to very different outcomes over time. The fourth pillar is competitive positioning and market dynamics. The restaurant industry is incredibly fragmented and competitive. There are hundreds of concepts competing for consumers' dining dollars. Understanding where a company sits in this competitive landscape is critical. You want companies that operate in categories with favorable dynamics, categories where there is room for multiple winners, categories where consumer demand is stable or growing, categories where the company has a defensible position. You want to avoid categories that are oversaturated, where too many competitors are fighting over a shrinking pie. You want to avoid categories that are being disrupted by delivery apps or changing consumer preferences, and you want to avoid companies that are stuck in the middle, neither the cheapest option nor the best quality option. The middle is the worst place to be in the restaurant industry, because you have no compelling reason for customers to choose you. The fifth pillar is valuation. This seems obvious, but it is where most investors make their biggest mistakes. They fall in love with a concept, they see the stock going up, and they pay whatever price the market demands. But even the best restaurant company is a bad investment if you pay too much for it. I look at restaurant stocks on a multiple of their free cash flow, adjusted for growth and quality. A high-quality restaurant company with strong unit economics, a powerful brand, great management, and favorable competitive positioning deserves a premium multiple. A lower-quality company deserves a discount. The key is understanding what you are buying and paying an appropriate price for it. Right now, at current valuations, I am seeing some high-quality restaurant companies trading at significant discounts to their intrinsic value. The market is worried about inflation, about consumer spending, about labor costs, about competition from delivery apps. And while these are all legitimate concerns, I believe the market is overreacting for certain specific companies whose fundamentals remain excellent. Let me now share the 3 restaurant stocks I would buy at these prices. I am going to go through each one in detail, explaining why it scores highly on all 5 pillars, and why the current valuation represents an attractive entry point. The first restaurant stock I would buy is Chipotle Mexican Grill. Now, I know what some of you are thinking. Chipotle has had its share of problems. The food safety issues several years ago were a disaster. The stock collapsed. Many investors wrote off the brand as permanently damaged. But what has happened since then is one of the most impressive turnarounds in restaurant history, and I do not think the market fully appreciates how strong this business has become. Let me walk you through the 5 pillars for Chipotle, starting with unit economics. Chipotle has some of the best unit economics in the entire restaurant industry. Average unit volumes are now over $3 million per restaurant, which is extraordinary for a fast casual concept. To put that in perspective, the average fast casual restaurant does about $1.5 million in annual sales. Chipotle is doing double that for. Wall margins are consistently above 25%, which is best in class. And the company can open new restaurants for about $1 million, meaning payback periods are under 2 years. Think about what that means. A franchisee, or in Chipotle's case, the company itself, since they do not franchise, can invest $1 million, generate over $3 million in sales, keep over $750,000 in restaurant level profit, and get their entire investment back in less than 2 years. Then they enjoy that $750,000 in annual profit for the remaining 15 to 20 years of the restaurant's life. Those economics are almost unheard of in the industry. I remember analyzing Chipotle's unit economics after the food safety crisis, when the stock had dropped over 50%. Even then, even with traffic down significantly, the unit economics were still solid. They were not great, but they were good enough to sustain the business while management fixed the problems. That told me the underlying model was incredibly strong. When traffic recovered, the economics would be spectacular, and that is exactly what happened. On brand strength, Chipotle owns the fast casual Mexican category in a way that few restaurants own any category. When people think of fast casual Mexican food, they think of Chipotle first. The brand stands for fresh ingredients, customization, and a step up from traditional fast food. That positioning has proven remarkably durable even through the food safety crisis. What is even more impressive is how the brand has strengthened in recent years. The new management team has refocused on food quality and customer experience. They have invested in digital ordering and loyalty programs that have created an even stronger connection with customers. The Chipotlane drive-through concept is expanding the addressable market by making it more convenient to get Chipotle in suburban locations. I have visited dozens of Chipotle locations in the past few years as part of my research, and what strikes me is the consistency of the experience. The food quality is reliable. The service is fast. The restaurants are clean. This kind of operational consistency across thousands of locations is very difficult to achieve, and it is a testament to how well the company is managed. On management quality, this is where Chipotle really shines. The current leadership team has executed flawlessly since taking over. They have improved operations, driven same-store sales growth, expanded margins, and grown the store base at a disciplined pace. Capital allocation has been excellent, with significant share repurchases when the stock was undervalued. I have studied this management team extensively, and they understand the business at a granular level. They know that restaurant success is built one burrito at a time, one customer at a time, one location at a time. They have not gotten distracted by flashy acquisitions or international expansion. They have stayed focused on making the core business better and better. That kind of discipline is rare and valuable. On competitive positioning, Chipotle operates in a favorable category with room to grow. Fast casual Mexican is a large market, and Chipotle has less than 5% share. They can continue opening new restaurants in the United States for many years before approaching saturation, and their competitive advantages, the brand recognition, the real estate expertise, the supply chain infrastructure, make it very difficult for competitors to challenge them. Yes, there are other Mexican concepts, but none of them have Chipotle's combination of scale, brand strength, and unit economics. The closest competitors are regional players or concepts that compete more directly with traditional fast food. Chipotle occupies a unique position in the market that is very difficult to replicate. On valuation, this is where it gets interesting. Chipotle currently trades at what looks like a premium multiple to the overall market. But when you adjust for the quality of the business and the growth runway, I believe the stock is actually attractively valued. The company should be able to grow earnings at 15 to 20% annually for the next decade through a combination of new unit growth, same-store sales growth, and margin expansion. Very few businesses offer that kind of durable growth. When I model out the free cash flow over the next 10 years and discount it back to today, I get a value significantly higher than the current stock price. The market is essentially giving you the growth for free, which rarely happens with a business of this quality. The second restaurant stock I would buy is Restaurant Brands International, the parent company of Burger King, Tim Hortons, and Popeyes. Now, this is a very different kind of investment than Chipotle. This is not about owning the best unit economics in the industry. This is about owning iconic brands with massive global scale that are being improved by excellent management. Let me explain why I find this so compelling. Restaurant Brands International is primarily a franchisor. They do not operate most of the restaurants themselves. Instead, they collect royalties from franchisees who operate over 30,000 locations worldwide. This franchise model is incredibly capital light and generates enormous free cash flow. Think about the economics. The company collects 4 to 5% of every dollar of sales from its franchisees. They do not have to pay for the labor, the food, the rent, or the build-out of new locations. Their only costs are the corporate overhead to support the system. This means that once you reach scale, the incremental margins on revenue growth are extraordinary. A company that can grow system sales by 5% might grow profits by 10 or 15% because of this operating leverage. On unit economics, I need to distinguish between the company's economics and the franchisee economics. The company's economics are exceptional because of the franchise model. They generate billions in free cash flow annually from royalties. The franchisee economics vary by brand and geography, but overall are solid enough to support continued system growth. Burger King has been the focus of improvement efforts. Historically, Burger King's unit economics lagged McDonald's significantly. Burger King restaurants generated lower sales and lower profits than McDonald's restaurants. But the current management team has been implementing what they call the Reclaim the Flame initiative, which is focused on improving operations, remodeling restaurants, and simplifying the menu. Early results are encouraging, with same-store sales improving and franchisee profitability increasing. I spent a lot of time studying the Burger King turnaround because it is critical to the investment thesis. What I found is that the problems were fixable. They were not fundamental issues with the brand or the category. They were operational issues that accumulated over years of underinvestment. The new management team is systematically addressing these issues, and the results are starting to show. Tim Hortons is the dominant breakfast and coffee brand in Canada, with unit economics that are excellent in its home market. The brand has over 70% awareness in Canada, which is extraordinary. Canadians love Tim Hortons in a way that Americans love their most iconic brands. The challenge has been expanding that success internationally, which has had mixed results. But the Canadian business is a cash cow that throws off enormous profits. Popeyes is the hidden gem in the portfolio since the famous chicken sandwich launch. Popeyes has seen a dramatic improvement in brand awareness and customer traffic. That chicken sandwich was a cultural phenomenon. It created lines around the block. It generated billions of social media impressions. And most importantly, it introduced Popeyes to millions of customers who had never tried the brand before. Unit economics have improved significantly since the chicken sandwich launch, and franchisees are now eager to open new locations. This brand has massive global growth potential that I do not think is fully reflected in the current valuation. Chicken is one of the fastest growing segments of the restaurant industry globally, and Popeyes is well positioned to capitalize. On brand strength, all three brands have significant recognition and loyal customer bases. Burger King is the number 2 burger chain globally. Tim Hortons is a Canadian institution. Popeyes has built a passionate following around its chicken. These are not brands that can be easily replicated or displaced. They have decades of history and emotional connections with consumers on management quality. This is another area where Restaurant Brands shines. The company is controlled by a Brazilian investment firm that has a remarkable track record of acquiring and improving restaurant brands. They bring operational discipline, a focus on franchisee profitability, and a long-term orientation that is rare in public markets. I have seen how this management team operates up close. They are relentless about reducing costs, improving operations, and driving same-store sales. They understand that their success depends on franchisee success, so they focus on making franchisees more profitable. This alignment of interests is critical in a franchise business. If franchisees are not making money, they will not reinvest in their restaurants, and the whole system deteriorates. On competitive positioning, each brand faces different competitive dynamics. Burger King competes with McDonald's and Wendy's in a mature market. Tim Hortons dominates Canada but faces challenges in other markets. Popeyes competes in the chicken category, which has been one of the fastest growing segments of the restaurant industry. The key insight is that you do not need all three brands to be firing on all cylinders for this investment to work. The franchise model generates so much cash flow that even modest improvements in performance translate into significant value creation. And if one or more brands can accelerate growth, the upside is substantial. On valuation, Restaurant Brands trades at a meaningful discount to comparable franchise businesses. This discount exists because of concerns about Burger King's performance and questions about the durability of the franchise model. I believe both concerns are overdone. Burger King is improving, and the franchise model is more durable than the market believes. At current prices, you are getting world-class brands and management at a very reasonable multiple. But the third restaurant stock I would buy is Darden Restaurants, the parent company of Olive Garden, Longhorn Steakhouse, and several other full-service dining concepts. Now, I know full-service dining has been out of favor with investors. The narrative has been that casual dining is dying, that consumers are shifting to fast casual and delivery, that the category is in permanent decline, and I think that narrative is mostly wrong, at least for the best operators in the category. Let me explain why Darden is such a compelling investment. First, you need to understand that Darden is not a typical casual dining company. They are the best operator in a challenged category, and that makes all the difference. While weaker competitors have struggled and failed, Darden has gained market share year after year. They are consolidating an industry, picking up the customers and the talent that are leaving struggling competitors. I have seen this playbook work before in other industries. When a category is in decline, the best operators often do extremely well because they take share from weaker players. The total pie might be shrinking, but their slice of the pie is growing faster than the pie is shrinking. That is exactly what is happening with Darden. On unit economics, Darden's restaurants generate strong sales and solid margins despite the headwinds facing the category. Olive Garden locations average over $5 million in annual sales, which is excellent for a casual dining concept. Longhorn Steakhouse has similar productivity. These are not struggling restaurants. These are well-run operations that deliver consistent profits. The company's scale provides significant advantages in purchasing, which keeps food costs lower than competitors. They buy more beef, more chicken, more produce than almost any other restaurant company. That purchasing power translates into lower costs and better margins. Their operational expertise means they can run restaurants more efficiently than most, and their real estate portfolio includes many owned properties, which provides flexibility and reduces occupancy costs. On-brand strength, Olive Garden and Longhorn are among the most recognized casual dining brands in America. Olive Garden in particular has a devoted customer base that appreciates the value proposition of unlimited breadsticks, generous portions, and consistent quality. The brand has stayed relevant by adapting its menu and marketing while staying true to its core identity. What I find remarkable is how resilient these brands have been. Despite constant predictions of their demise, they continue to deliver solid same-store sales growth and attract customers. The death of casual dining has been greatly exaggerated, at least for the strong operators. People still want to sit down for a nice meal with family and friends. They still want the experience of being served and taken care of. Darden delivers that experience consistently and at a fair price. On management quality, Darden has one of the best management teams in the restaurant industry. They have a disciplined approach to capital allocation, returning significant cash to shareholders through dividends and buybacks. They have made smart acquisitions that expanded their portfolio without overpaying, and they have continuously improved operations through technology and process improvements. The current leadership has done an exceptional job of navigating the challenges of inflation, labor shortages, and changing consumer preferences. They have raised prices strategically to protect margins without driving away customers. They have invested in technology to improve the guest experience and increase efficiency, and they have maintained the value proposition that makes their brand successful. On competitive positioning, this is where Darden's strength really becomes apparent. The casual dining category has seen massive consolidation over the past decade. Weaker players have closed locations or gone bankrupt entirely. Red Lobster, Applebee's, TGI Fridays, and many other brands have struggled. The survivors are fighting for a shrinking number of customers. In this environment, Darden's operational excellence gives them a huge advantage. They can offer better food, better service, and better value than struggling competitors. Every time a competitor closes a location, Darden picks up some of those customers. This dynamic is incredibly powerful over time. As the category consolidates, the survivors get stronger. They gain market share. They gain the best talent. They gain the best real estate locations. Darden is the clear winner in this consolidation process, and I expect that to continue for years. On valuation, Darden trades at a discount to the market, despite its consistent execution and shareholder-friendly capital allocation. The discount exists because investors are skeptical of the casual dining category. I think that skepticism is overdone for a company of Darden's quality. The stock offers an attractive dividend yield, significant share buyback support, and modest but consistent earnings growth at current prices. You are getting a high-quality business at a reasonable valuation. Now let me synthesize what these three stocks have in common and what we can learn from analyzing them together. All three companies have strong unit economics, though the specific metrics look different based on their business models. Chipotle has exceptional company-operated restaurant economics. Restaurant Brands has exceptional franchise royalty economics. Darden has strong full-service restaurant economics for a challenging category. All three companies have brands with genuine meaning in consumers' minds. They are not generic concepts competing solely on price. They own mental real estate in specific categories that would be very difficult for competitors to take away. All three companies have excellent management teams with track records of value creation. These are not turnaround situations where you are hoping new management can fix a broken business. These are well-run companies where management has demonstrated they know how to allocate capital and drive results. All three companies have favorable competitive positioning within their categories. Chipotle dominates fast casual Mexican. Restaurant Brands owns iconic global brands with franchise scale. Darden is the best operator in casual dining consolidation. And all three companies are trading at valuations that do not fully reflect their quality and prospects. The market is concerned about various short-term issues: inflation, consumer spending, labor costs, category headwinds. But these concerns are creating opportunities to buy great businesses at reasonable prices. Let me talk about how to apply this framework to other restaurant investments you might be considering. The 5 pillars I described are universal. Any restaurant stock you analyze should be evaluated on unit economics, brand strength, management quality, competitive positioning, and valuation. If a company scores poorly on any of these pillars, you should be very cautious about investing. The most common mistake I see investors make is focusing too much on the concept and not enough on the economics. They eat at a restaurant, they like the food, they see the stock going up, and they buy without doing the fundamental work. But your personal dining preferences are not an investment thesis. Plenty of restaurants serve great food and still fail as investments because the unit economics do not work, or the management makes poor decisions. Another common mistake is ignoring the competitive dynamics. The restaurant industry is brutally competitive. New concepts emerge constantly. Consumer preferences shift. What works today may not work tomorrow. You need to invest in companies that have sustainable advantages, not just current popularity. A third mistake is paying too much for growth. Restaurant companies can grow rapidly by opening new locations, but that growth only creates value if the new locations are profitable. I have seen many restaurant stocks collapse because management opened too many restaurants too quickly, diluting the economics and destroying the brand. Disciplined growth is far more valuable than rapid growth. Let me close with some thoughts on why now is a particularly interesting time to invest in restaurant stocks. The past few years have been challenging for the industry. The pandemic forced closures and changed consumer behavior. Inflation has pressured both costs and consumer spending. Labor shortages have made it difficult to staff restaurants properly. Delivery apps have disrupted traditional business models. But the strong operators have navigated these challenges and emerged even stronger. The companies I have highlighted today have proven their resilience. They have adapted to changing conditions while staying true to what makes them successful, and their stocks are trading at valuations that reflect the challenges, but not the underlying quality of the businesses. I believe we are at an inflection point where the best restaurant companies will pull further ahead of weaker competitors. The industry consolidation that has been underway for years is accelerating. The survivors will have more pricing power, better real estate, and stronger brands. The investments made today in high-quality restaurant companies will look very smart 5 and 10 years from now. When I look back at the restaurant investments I have made over the past 3 decades, the common thread is quality. I bought companies with strong unit economics, powerful brands, excellent management, and favorable competitive positioning. Sometimes I paid premium prices, sometimes I got bargains, but the quality of the underlying business was always the most important factor. Quality compounds over time in ways that are difficult to appreciate in the moment but obvious in hindsight. The restaurant industry will always be challenging. There will always be new competitors, changing tastes and economic cycles. But the fundamental human need to eat outside the home is not going away. People will always want to gather with family and friends over a meal. They will always want the convenience of someone else cooking for them. They will always want the experience of trying new flavors and cuisines. The companies that can consistently deliver quality food, good service, and fair value will continue to thrive. And the investors who can identify those companies and buy them at reasonable prices will continue to build wealth. That is exactly what I am doing with these 3 stocks. Chipotle for premium growth in fast casual restaurant brands for global franchise scale. Darden for value and consolidation in casual dining together. They represent a diversified approach to one of the most enduring industries in human history, and that is exactly what you are now equipped to do as well.